Good morning and namaskar. This is the first monetary policy statement of the current financial year 2022-23. I welcome everyone to this statement, which will be followed subsequently at 12 o'clock by the usual press conference. 2 years ago in March 2020, we began a journey to fight the onslaught of COVID-19 on our economy with courage and determination. During the period thereafter, the Reserve Bank has successfully navigated its course through has scarred our psyche and tested our resilience. We have responded with bold, unconventional, and resolute measures to stabilize the economy through the three waves of the pandemic. As the situation normalized, we have taken measures towards rebalancing liquidity conditions while ensuring that our actions are nimble and proactive but well-timed. Now, 2 years later, as we were emerging out of the pandemic situation, the global economy has seen tectonic shifts beginning 24th February, with commencement of the war in Europe, followed by sanctions and escalating geopolitical tensions. We are confronted with new but humongous challenges: shortages in key commodities, fractures in international financial architecture, and fears of deglobalization. Extreme volatility characterizes commodity and financial markets. While the pandemic quickly morphed from a health crisis to one of life and livelihood, the conflict in Europe has the potential to derail the global economy. Caught in the cross-current of multiple headwinds, our approach needs to be cautious but proactive in mitigating the adverse impact on India's growth, inflation, and financial conditions. We are, however, reassured by the strong buffers that we have built over the past few years, including large foreign exchange reserves, significant improvement in external indicators, and substantial strengthening of the financial sector, all of which would help us to weather this storm. Please note that I'm emphasizing on three different aspects which places us in a position that would enable us to deal with the emerging crisis and the challenges. The first, significant improvement in the external sector. The second, foreign exchange reserves, which are at very comfortable levels. And third, substantial strengthening of the financial sector. I will be dwelling upon this in detail in the later part of my statement. Once again, we in the Reserve Bank stand resolute and in readiness to defend the economy and navigate out of the current storm. Let me now turn to the decisions and deliberations of the Monetary Policy Committee. Against this backdrop, the Monetary Policy Committee, that is MPC, met on 6th, 7th, and 8th April, and based on an assessment of the macroeconomic situation and the outlook, voted unanimously to keep the policy repo rate unchanged at 4%. The MPC also decided unanimously to remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. The marginal standing facility, that is MSF rate and bank rate, remain unchanged at 4.25%. Further, it has been decided by the Reserve Bank to restore the width of the liquidity adjustment facilities, that is the LAF, LAF, that is the LAF corridor, to 50 basis points, 50 to 50 basis points, the position that prevailed before the pandemic. The floor of the corridor will now be provided by the newly instituted Standing Deposit Facility, SDF, which will be placed 25 basis points below the repo rate, that is at 3.75%. I shall explain the details in this regard in the later part of my statement. Let me first dwell upon the MPC's rationale for its decision on the policy rate and the stance. Since the MPC's last meeting in early February 2022, the expected positive benefits from the ebbing of the Omicron wave have significantly changed. Omicron wave have been offset by the sharp escalation in geopolitical tensions. Let me just read this sentence again. Since the MPC's last meeting in February 2022, the expected positive effects of the Omicron wave, expected positive benefits from the ebbing of the Omicron wave have been offset by sharp escalation in geopolitical tensions. This has significantly changed the external and domestic landscape. Concerns over protracted supply disruptions have rattled global commodity and financial markets. Given the significant share of the two economies engaged in the war in global production and exports of key commodities like oil and natural gas, wheat and corn, palladium, aluminium and nickel, edible oil and fertilizers. Now these are, I have listed out the points which basically are at the root of the concerns over the protracted supply disruptions which are causing all these turbulence and in all these areas. So concerns over protracted supply disruptions have rattled commodity and financial markets. Given the significant share of the two economies engaged in war in global production and exports of key commodities like oil and natural gas, wheat and corn, palladium, aluminium and nickel, edible oil and fertilizers. I repeated this sentence so that there is clarity in, there is clarity in our communication. Global crude oil prices briefly crossed $130 per barrel, touching their highest level since 2008, and remain volatile at elevated levels despite some recent correction. Global food prices, along with metal and other commodity prices, have also hardened significantly. Risk aversion towards assets of emerging market economies has increased, leading to large capital outflows and depreciating bias in their currencies, that is, currencies of the emerging market economies. These developments have first ratcheted up the projections of global inflation, which was already running well above the target in the major countries, and second, will produce sizable adverse impact on output across geographies. The geopolitical tensions have exacerbated at a time when the global economy was grappling with a sharp rise in inflation and consequent monetary policy normalization in major advanced economies. Global supply chain disruptions and input cost pressures are now expected to linger even longer. The resurgence of COVID-19 infections in some major economies in March and the associated lockdowns run the risk of further aggravating the global supply bottlenecks and input cost pressures. World trade and output, and hence external demand, are likely to be weaker than envisaged 2 months back. Overall, the external developments during the past 2 months have led to materialization of downside risks to domestic growth and upside risks to inflation. And upside risks to the inflation projections that was made during the MPC meeting of February this year. Inflation is now projected to be higher and growth lower than the assessment during February. Economic activity, although recovering, is barely above its pre-pandemic level. Against this backdrop, the MPC decided to retain the repo rate at 4%. It also decided to remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. I would now like to provide our assessment of growth and inflation. And first, I would take up growth. According to the second advance estimates released by the National Statistics Office, NSO, on February 28, real GDP rose by 8.9% in 21-22. Private consumption and fixed investment, key drivers of the domestic demand, however, remain subdued, with these two components being only 1.2% and 2% respectively above their pre-pandemic levels. On the supply side, contact-intensive services still trail the 2019-20 level. Nevertheless, the Indian economy is steadily reviving from its pandemic-induced contraction. During 21-22, weaknesses in economic activity resurfaced in third quarter and got exacerbated by emergence of the Omicron variant in January 2022. A gradual turnaround has been noticed during February, although in March, a mixed picture was seen. Some contact-intensive activities have regained traction amidst declining infections and removal of restrictions. Several high-frequency indicators, namely railway freight, GST collections, toll collections, electricity demand, fuel consumption, and imports of capital goods, posted robust year-on-year expansion during the months of February and March. With the easing of restrictions, domestic air passenger traffic rebounded in the month of March. According to our surveys, consumer confidence is improving and households' optimism in outlook for the year ahead has strengthened with an uptick in sentiments. Business confidence is in optimistic territory and supportive of revival in economic activity. On the other hand, passenger vehicle sales and registrations continue to contract, although at a moderating pace. Both manufacturing and services PMIs remain in the zone of expansion. While manufacturing PMI moderated slightly in March, services and composite PMI showed improvement. Going forward, robust Rabi output should support recovery in rural demand, while a pickup in contact-intensive services should help in further strengthening urban demand. Investment activity may gain traction with improving business confidence, pickup in bank credit, continuing support from government capex, and congenial financial conditions. Capacity utilization in the manufacturing sector recovered further to 72.4%, that is 72.4% in third quarter 21-22 from 68.3% in the previous quarter, surpassing the pre-pandemic level of 69.9% in the fourth quarter of 2019-20. As the horizon was brightening up, escalating geopolitical tensions have cast a shadow on our economic outlook. Although India's direct trade exposure to the countries at the epicenter of the conflict is limited, the war could potentially impede the economic recovery through elevated commodity prices and global spillover channels. Further, financial market volatility induced by monetary policy normalization in advanced economies, renewed COVID-19 infections in some major countries with augmented supply-side disruptions and protracted shortages of critical inputs such as semiconductors and chips pose downside risks to the growth outlook. Taking all these into consideration, all these factors that I have just explained in the previous 5 to 6 minutes, taking all these into consideration, real GDP growth for the year 2022-23, that is the current financial year 22-23, is now projected at 7.2%. I repeat, 7.2%, with Q1 22-23 at 16.2%, Q2 at 6.2%, Q3 at 4.1%, and Q4 at 4%, assuming crude oil, that is Indian basket, at US dollar 100 per barrel during the year 2022-23. Let me now turn to inflation. In February 2022 meeting of the MPC, we had projected a moderating path of inflation during 22-23. Heightened geopolitical tensions since end February have, however, upended the earlier narrative and considerably clouded the inflation outlook for the year. On the food price front, a likely record Rabi harvest would help to keep domestic prices of cereals and pulses in check. Global factors such as loss of wheat supply from the Black Sea region and the unprecedented high international prices of wheat could, however, put a floor under domestic prices of wheat. Edible oil price pressures are likely to remain elevated in the near term due to export restrictions by key producers, as well as loss of supply from the Black Sea region. Feed cost pressures could continue due to global supply shortages, which could also have a spillover impact on poultry, milk, and dairy product prices. Coming to non-food items, the spike in international crude oil prices since end February poses substantial upside risk to inflation through both direct and indirect effects. Sharp increase in domestic pump prices could trigger broad-based second-round price pressures. A combination of high international commodity prices and elevated logistic disruptions could aggravate input costs across agriculture, manufacturing, and the services sectors. Their pass-through to retail prices, therefore, warrants continuous monitoring and proactive supply management. Financial markets are likely to remain volatile on rising risk premia, dislocations in trade and capital flows, and divergent monetary policy responses across central banks. Taking into account these factors, and on the assumption of a normal monsoon during 2022, and average crude oil price, that is the Indian basket, at US dollar 100 per barrel, 100 per barrel, inflation is now projected at 5.7%. I repeat, inflation is now projected at 5.7% in 2022-23, with Q1 at 6.3%, Q2 at 5%, Q3 at 5.4%, and Q4 at 5.1%. It may, however, be noted that given the excessive volatility in global crude oil prices since late February and the extreme uncertainty over the evolving geopolitical tensions, any projection of growth and inflation is fraught with risk and is largely contingent upon future oil and commodity price developments. In this context, continuation and deepening of supply-side measures may alleviate food price pressures and also mitigate cost push pressures across manufacturing and services. On our part, let me assure all stakeholders that, as in the past, the Reserve Bank will use all its policy levers to preserve macroeconomic stability and enhance the resilience of our economy. The situation is dynamic and fast-changing, and our actions have to be tailored accordingly. I would now like to turn to liquidity and financial market conditions. As stated earlier, the macroeconomic outlook is undergoing tectonic shifts, and our policy response has to be preemptive and recalibrated dynamically to the evolving outlook. The Reserve Bank will continue to adopt a nuanced and nimble-footed approach to liquidity management while maintaining adequate liquidity in the system. Let me again read this statement because it's very important and the communication should be very clear to the market. The Reserve Bank will continue to adopt a nuanced and nimble-footed approach to liquidity management while maintaining adequate liquidity in the system. At present, liquidity management is characterized by two-way operations through variable rate reverse repo auctions, that is VRRR auctions, of varying maturities to absorb liquidity, and variable rate repo auctions, that is VRR auctions, variable rate repo auctions to meet transient liquidity shortages and offset mismatches. This approach will be continued. It may be noted that the interest rate for around 80% of the liquidity absorbed under the LAF during the fourth quarter of 21-22 has firmed up close to the policy repo rate due to the rebalancing of liquidity through our VRRR auctions. Accordingly, financial participants and financial markets have been prepared for the eventual normalization of the LAF corridor, which we are doing today. So therefore, the normalization of the LAF corridor should not come as a surprise to the market, because we have prepared the market over the last several months, whereby the 80% of the liquidity is being absorbed at a rate close to the repo rate. Further, it has now been decided to fully restore the liquidity management framework instituted in February 2020, albeit with some refinements to enhance its effectiveness. Accordingly, the following measures are being instituted. 1. The amendment to Section 17 of the RBI Act in 2018 empowered the Reserve Bank to introduce the Standing Deposit Facility, that is SDF. By removing the binding collateral constraint on the central bank, the SDF strengthens the operating framework of monetary policy. Accordingly, it has now been decided to introduce SDF as the floor of the LAF corridor. This would provide symmetry to the operating framework of monetary policy by introducing a standing absorption facility at the bottom of the LAF corridor, similar to the standing injection tool at the upper end of the corridor, namely the marginal standing facility. Thus, at both ends of the LAF corridor, you see both ends currently, after we have introduced SDF at 3.75. Currently, the LAF corridor, therefore, the 50 basis points corridor is 3.75% SDF at the lower end of the corridor and 4.25% at the upper end of the corridor through the instrumentality of the MSF. So thus, at both ends of the LAF corridor, there will be standing facilities, one to absorb the liquidity and the other one to inject liquidity. SDF absorbs liquidity, MSF would inject liquidity, and this will depend on the evolving financial market conditions. It can vary from day to day also. Accordingly, access, and further, this is very important to note, that access to SDF and MSF will be at the discretion of the banks, because they are standing facilities. They will be at the discretion of the banks, unlike repo, reverse repo, OMO and CRR, which are available at the discretion of the Reserve Bank. So the standing facilities give the discretion to the banks. And the other tools I mentioned, the OMO, the reverse repo, or the CRR actions, if any, they are at the discretion of the Reserve Bank. Notably, and this is very important to note, that SDF is also a financial stability tool in addition to its role in liquidity management. So the introduction of SDF is for twin objective of doing proper and appropriate liquidity management in the current context, and also to further strengthen financial stability. So it has two broad objectives. The second point, I mentioned that there are, we are instituting several measures. The first one I have said. The second point is as follows. The SDF rate will be 25 basis points below the policy rate, and it will be applicable to overnight deposits at this stage. It would, however, retain the flexibility to absorb liquidity of longer tenors as and when the need arises, with appropriate pricing. The MSF rate will continue to be 25 basis points above the repo rate. Thus, the width of the LAF corridor is restored to the pre-pandemic configuration of 50 basis points symmetrically around the policy repo rate, which will be at the center of the corridor. 3. The third announcement, the fixed rate reverse repo, that is FRRR, if I can put it that way. The fixed rate reverse repo FRRR rate is retained at 3.35%. It will remain as part of RBI's toolkit. However, its operation will be at the discretion of the Reserve Bank for purposes to be specified from time to time. The FRRR, that is fixed rate reverse repo, along with the SDF, will impart flexibility to RBI's liquidity management framework. 4. Both MSF and SDF will be available from 17:30 hours to 23:59 hours on all days of the week throughout the year, from 5:30 p.m. to 11:59 p.m. on all days of the week throughout the year, irrespective of holidays or Saturdays or Sundays. 5. It has been decided to restore the opening time of financial markets regulated by the Reserve Bank to the pre-pandemic timing of 9 a.m., that is 9 in the morning, with effect from 18th April, without any change in their closing time prevailing at present. During the pandemic, now these are some of the announcements I made. I will now proceed on. During the pandemic, the Reserve Bank offered liquidity facilities of the order of rupees 17.2 lakh crore, of which 11.9 lakh crore was utilized. So far, 5 lakh crore has been returned or withdrawn on the lapse of various facilities on their due dates. The extraordinary liquidity measures undertaken in the wake of the pandemic, combined with liquidity injected through various other operations of the Reserve Bank, have left a liquidity overhang in the order of about rupees 8.5 lakh crore in the system. The RBI will engage in gradual, calibrated withdrawal of this liquidity over a multi-year time frame in a non-disruptive manner beginning this year. I'll repeat this sentence. The Reserve Bank will engage in gradual and calibrated withdrawal of this liquidity over a multi-year time frame in a non-disruptive manner beginning this year. The objective is to restore the size of the liquidity surplus in the system to a level consistent with the prevailing stance of monetary policy. While doing so, I would like to reiterate our commitment to ensure the availability of adequate liquidity to meet the productive requirements of the economy. We also remain focused on completion of the borrowing program of the government, and towards this end, the Reserve Bank will deploy various instruments as warranted. I would now like to focus on the external sector. Despite the worsening global supply shocks slowing the recovery in the world economy, India's merchandise exports grew robustly in 2021-22, overshooting the target of $400 billion. A sharp escalation in international commodity prices, in conjunction with domestic demand recovery, has also led to strong rebound in imports and a widening of trade and current account deficits. The sustained and robust growth in the services exports and inbound remittances continue to keep our invisible account in large surplus, which helps to offset partly the merchandise trade deficit. Despite the sharp jump in crude oil prices and other commodity prices, we expect the current account deficit to remain at sustainable levels, which can be financed with normal capital flows. Overall, our external sector indicators remain healthy and have improved significantly in the recent years. Our foreign exchange reserves stand at 606.5 billion as on 1st April, which are further bolstered by the net forward assets of the Reserve Bank. The Reserve Bank remains committed to maintain orderly conditions in the domestic financial markets and will take appropriate steps as needed on ongoing basis to contain the adverse spillovers from the global developments. I would now like to announce certain additional measures. There are, I think, 6 or 7 announcements, and I shall be quick. First announcement relates to individual housing loans, rationalization of risk weights. The risk weights for individual housing loans were rationalized in October 2020 by linking them only with loan-to-value ratios for all new housing loans sanctioned up to 31st March 2022. Recognizing the importance of housing sector and its multiplier effects, it has been decided to extend the applicability of these guidelines till 31st March 2023. This will facilitate higher credit flow for individual housing loans. The next announcement relates to SLR holdings in the HTM category. With a view to enable the banks to better manage their investment portfolio during 2022-23, it has been decided to enhance the present limit under held to maturity, that is HTM category, from 22% to 23% of the NDTL till 31st March 2023. It has also been decided to allow banks to include eligible securities, that is eligible SLR securities acquired between 1st April 2022 and 31st March 2023 under this enhanced limit. The HTM limits would be restored from 23% to 19.5% in a phased manner starting from the quarter ending June 30th, 2023. Next announcement relates to discussion paper on climate risk and sustainable finance. Climate change poses certain risks that could have implications for the safety and soundness of financial institutions as well as financial stability. To facilitate better understanding and assessment of the potential impact of climate-related financial risks by the regulated entities of RBI, a discussion paper on climate risk and sustainable finance will be published shortly for feedback. Next relates to Committee for Review of Customer Service Standards in RBI regulated entities. The Reserve Bank has over the years taken a number of measures to enhance consumer protection. These measures include laying down regulatory frameworks on customer service, internal grievance redress mechanism, and the ombudsman mechanisms. In view of the transformation underway in the financial landscape due to innovations in products and services, deepening of penetration and emergence of various deepening of the digital penetration and emergence of various service providers, it is proposed to set up a committee to examine and review the current state of customer service in all the RBI regulated entities. And this committee will focus on adequacy of customer service regulations which are prevalent at present and will suggest measures to improve them in the future. Next announcement relates to interoperability in cardless cash withdrawal, that is interoperable cardless cash withdrawal at the ATMs. At present, the facility of cardless cash withdrawal through ATMs is limited only to a few banks. It is now proposed to make cardless cash withdrawal facility available across all banks and ATM networks using the UPI. In addition to enhancing ease of transactions, the absence of the need for physical card for such transactions would help prevent frauds such as card skimming, card cloning, etc. Next announcement relates to Bharat Bill Payment System, rationalization of the net worth requirement for the operating units. The Bharat Bill Payment System, BBPS, an interoperable platform for bill payments, has seen an increase in volume of bill payments and billers over the years. To further facilitate greater penetration of bill payments through the BBPS and to encourage participation of a greater number of non-bank Bharat Bill Payment operating units in this system, it is proposed to reduce the net worth requirement of such entities from rupees 100 crore to rupees 25 crore. Next announcement, and that's the last announcement before, and after that I would just proceed to conclude and give some broad messages for the coming period. The next announcement relates to cyber resilience and payment security controls of payment system operators. Payment systems play a catalytic role in facilitating financial inclusion and promoting financial stability. To ensure that our payment systems remain resilient to conventional and emerging risks, specifically those relating to cyber security, it is proposed to issue guidelines on cyber resilience and payment security controls for payment systems, for payment system operators. I would now like to conclude. The last 2 years have seen turbulence and uncertainty of epic proportions. At the Reserve Bank, we have worked unrestingly to mitigate their impact on our economy. When I look back, I see that we have traversed an arduous path with candor, courage, and conviction that a brighter future lies ahead. The conflict in Europe now poses a new and overwhelming challenge complicating an already uncertain global outlook. As the daunting headwinds of the geopolitical situation challenge us, the Reserve Bank is braced up and prepared to defend the Indian economy with all instruments at its command. As we have demonstrated over the last 2 years, we are not hostage to any rule book. And no action is off the table when the need of the hour is to safeguard the economy. Our goals of price stability, sustained growth, and financial stability are mutually reinforcing, and we continue to be guided by this approach. The sky today may be overcast with clouds, but we will use all our energies, resolve, and resources to let the sunlight illuminate India's future. Let me end by recalling what the father of our nation, Mahatma Gandhi, had said long ago. It is faith that steers us through stormy seas, faith that moves mountains, and faith that jumps across the ocean. Thank you. Stay safe. Stay well. Namaskar.